program, and the SEC FASB support for the rules. We're very happy to have some great speakers with us today. Before we get started, I want to cover a few logistical points. If you have questions, which you can submit during the course of the program, just click on the Q&A link that you see in your console and send us your questions, and we'll be happy to take them as they come in. If you have any kind of technical issues, please email us at support@xbrl.us, and we'll do our best to get you back online. We wanted to mention that this program is brought to you by the support of the Center for Data Quality. The Center for Data Quality is comprised of member organizations of XBRL US, including Topan Merrill, DataTrax, the AICPA, P3 Data Systems, Altova, Donnelly Financial Services, or DFIN, Certant, an Insight software company, RDG Filings, Broadridge Financial Solutions, and Workiva. And we want to thank them all for supporting and funding the work of the Data Quality Committee. I'm just going to talk through the agenda that we have today. We're first going to hear from Joan Berg. Joan is the chair of the Data Quality Committee. She is also director of XBRL Services at Topan Merrill. And Joan is going to talk to us a little bit about the Center for Data Quality and the Data Quality Committee. And she's going to walk us through an analysis of the DQC rules and how they've been working to combat some of the errors that we've seen in filings. That's going to be followed up by Amy Beers. Amy is a CPA, CGMA, Senior Director of Assurance and Advisory Innovation in Public Accounting at the American Institute of CPAs, the AICPA. Amy is going to cover the SEC Edgar system support for DQC rules. We'll then take a couple of CPE questions for those of you who are getting CPE. As always, you'll just need to click on the appropriate response when you see the poll question coming up. We'll cover 2 questions at that point. Then we're going to turn it over to Campbell Pride, who's president and CEO of XBRL US. Campbell is going to give a review of the proposed Ruleset 15. And then finally, we'll cover a couple of additional CPE questions and cover upcoming events and programs. So with that, I'm going to turn it over to Joan, who's going to talk to us about the Center for Data Quality.
Thanks, Michelle, and welcome to our meeting today. The Center for Data Quality was formed in 2015 to address the public's concern about the quality and the usability of XBRL financial data. Comprised of a combination of service providers, data analysts, and filers, this group seeks to establish tools that will improve the reliability of XBRL data. The Data Quality Committee identifies topical areas where further guidance is needed and establishes rules that can automatically detect noncompliance with this guidance. The rules are issued in sets and are exposed for public review 3 times a year. The committee also meets with representatives from the SEC 2 times a year and discusses progress made with rule development and error detection. The DQC rules are freely available through the XBRL US website. Members of the DQC include preparers, analysts, service providers, and tool providers. As shown on this slide, we also benefit from the input of permanent observers representing the FASB and IASB. The bulk of the work of the committee is carried out by a dedicated group representing most of the major service providers. This group, which is listed on this slide, meets twice a month. This group reviews the impact of proposed rules prior to their issuance and reviews comments received from the public during the exposure periods. Proposed rules are modified based on the findings from these reviews. And now I'm going to walk through some of the trends in the error rates resulting from these rules. Currently, we have 66 rules that are implemented, with another 9 exposed for public comment. The chart shows the improvement in just the last 5 quarters. You will notice the blue boxes that identify how many errors in the line graph are contributed from rules that are new. In the first quarter of 2020, we reported a total of 34,212 errors for the rules that were effective in that period. In the first quarter of 2021, after adding 16 more rules that increased our error count by 4,614, we reported 20,222 errors. So I'm trying to say we don't have apples and oranges here. But if we subtract the impact from the new rules, we had over a 50% reduction in errors reported under rules that were in place in both Q1 2020 and Q1 2021. Keep in mind, as you look at this data, that the first quarter of the year contains the 10K files of companies with calendar year ends. And we know that typically those 10K filings contain twice as many values as a 10Q for the same registrant. So we expect big dips in the interim quarters. I want to drill down a little more on the rules that generated the most errors. Only 4 rules had over 1,000 errors in the first quarter of 2021. I'm going to talk about each of these individually. Rule 1 was approved in September 2016. And at that time, we had identified 22 axes where we could restrict which members were appropriate for inclusion on the axis. Since that time, we have added 6 more axes, the most recent one being added in version 14 of the rules, which became effective January 1 of this year. DQC 15 was the first rule that was implemented. It became effective January 1, 2016. But each year, with the introduction of a new US GAAP taxonomy, some elements are removed from the list and other new elements are added. So we have something of a moving target in trying to correct these errors. DQC 15 currently checks 6,311 elements to see if a negative amount was entered into an element where a positive value is expected. Rule 81 is a relatively new rule. It became effective at the beginning of the fourth quarter of 2020. It looks at the parent-child sibling relationships established in the US GAAP taxonomy, and it enforces that structure in the registrant's extension taxonomy. Where those relationships are not maintained, it flags an error. And finally, on this slide, Rule 99 became effective at the beginning of this year. So this is the first quarter that errors were tabulated. It is looking for missing calculation relationships for line items including in the balance sheet, income statement, statement of comprehensive income, or statement of cash flows. Slide 10 gives a better understanding of the types of errors we are seeing on DQC1. Because of the way the rule works, every value that is tagged with a member axis mismatch is counted as an error. So there were 4,490 errors on this rule in the first quarter of 2021, and 60% of those are represented on this slide. As you can see, there are a relatively small number of companies making these errors, 184. The first bullet here is the axis that was just added to this rule this quarter, the statement business segments axis. An error is reported if members from other US GAAP axes are used. For example, if you used computer equipment member instead of the name of your own business segment, an error would be flagged. The second bullet has been on here for a long time. It's always been one of the top errors on this rule. Typically, it relates to using members from the class of stock axis on the equity components axis, whereas both axes are required on the statement of shareholders' equity. We did add further clarification to the rule message in hopes of correcting this error. And finally, the range axis was the third highest axis with errors. It had 446 errors. That axis only permits standard taxonomy members on it. You can't make up extension members like lowest alternative interest rate member. And just 21 companies seem to be struggling with this one. Slide 11 lists the top 3 errors on the negative value rule. These numbers individually are not big. As a general rule, we find this error is happening in inline filings where the presentation shows an amount in parentheses. Those parentheses need to be removed for data entry and the label negated. Slide 12 provides further analysis of the types of errors we are seeing with DQC Rule 81. This rule just became effective in the fourth quarter of 2020. And I've shown here examples of the 2 ways that the rule detects errors. So the first one is if the standard taxonomy represents an element as a child of another element. So if in the standard taxonomy, convertible notes payable is one of the children of notes payable. If you put it as a sibling in your file, it will be represented it will come out as an error. And similarly, in the standard taxonomy, the cost of goods sold and operating expenses are both represented as siblings. So if you were to put in your file in the example, the cost of goods and services sold is a child of operating expenses, the rule will flag an error. This is a very common error, and so we modified the rule message to tell filers how to correct the error. Because this is a new rule, we are monitoring the results, and we hope to see continued improvements as we provide clearer guidance in our rule messages. Slide 13 deals with one of our newest rules. Rule 99 became effective January 1 of this year. During the impact analysis, we had identified 5,000 errors on this rule. And after the exposure period, some filers corrected their filings. So in Q1, we had 1,400 errors with 700 companies showing no calculation on one of the face financial statements or partial calculations. So the rule looks at all the calculation relationships in the file and flags an error if one of the line items in the presentation link rule is not included in a calculation relationship. In the example on this slide, you can see that some line items that were nested on the face of the income statement were not included in the calculation relationship. So the rule message contains tips as to how to fix some of the most frequent errors we saw during the review period. Missing calculations has always been one of the major problems cited by the SEC, detracting from their ability to utilize XBRL data. We believe that this rule will make a major contribution to the improvement of data quality, and hope these 700 companies can get this right in their next filing. Slide 14 identifies the new rules, which just became effective on May 1 after a public exposure period that ended in December of 2020. These rules are geared towards filers using the IFRS taxonomy, and they mimic rules that are already in place for US GAAP filers. Rule 104 is similar to Rule 001 that we discussed for US GAAP filers. In order to put that rule in place, we had to issue guidance as to the use of several axes in the IFRS taxonomy, as that organization does not issue tagging guidance in the same way as the FASB does. This guidance was reviewed, however, by the IASB representatives, and it's appropriate to be followed in filings made with the SEC. The errors shown on this slide were the errors that were made in Q1 2021, before the rules became effective, but possibly before the majority of 20Fs and 40Fs were filed. So as you can see, there's plenty of room for improvement on Rule 104. Hopefully that presentation gives you a good perspective on the efforts made by the DQC to improve data quality. This work has been acknowledged by the SEC, and Amy Bierce from the AICPA is going to provide an update on how the SEC is incorporating the rules into EDGAR.
Thanks, Joan. So if we can move to the next slide. As Joan mentioned, the DQC is a market-led initiative, and we've been working for a number of years, and we've been slowly gaining traction, as Joan showed with the improvement of the error rates. that we've seen over the past year and over the past 5 years. But there are still errors in the filings. And in order to make a difference, in order to reduce errors down to a level of 0, which is really where we should be, we really need some enforcement. And so back in June of 2018, the DQC sent the SEC a letter with observations and recommendations on the SEC program. And we had 2 recommendations really to address the fact that errors were still persisting. Although the DQC rules were in place and a majority of filers were running these rules, we still had errors. So the 2 recommendations that we made in the June 2018 letter were, 1, for the SEC to make registrants aware of and encourage them to use the freely available DQC rules and guidance, and that the DQC rules could be added to the SEC filing engine so that filers, as they're filing their filings, could check their rules. And number 2, that the SEC strengthen its monitoring of XBRL filings and take steps to increase the compliance with the SEC's XBRL rules. So in August of that year, we saw that the SEC did announce that they plan to flag errors in SEC filings. And by October of that year, they started to introduce error messages and to start flagging a sample of errors. Now, in the background, the DQC started working with FASB. And we worked with FASB to incorporate our rules into the US GAAP taxonomy. That way that as filers are looking and using the taxonomy, the elements that are included in the rules were also in the taxonomy itself. So the idea there is to just make it as easy as possible for filers to understand the rules. So in February 2020, the FASB had incorporated 3 of the DQC's rules, and they established the DQC taxonomy, which is the DQC RT, or the DQC rules taxonomy. Now, FASB goes through a due diligence process to vet and test the quality of the rules to make sure that there's no false positives before they incorporate any of the DQC's rules into their taxonomy. And so they will be monitoring that process throughout. And finally, we see this past February, the SEC finally announced that EDGAR will support the DQC rules taxonomy, and that they will be doing quality enhancing checks for those rules that are included in the FASB's taxonomy. So moving on to the next slide. This just as a slide that shows you can go to the US GAAP taxonomy, and if there's an entry point for the DQC rules, it's really hard to see on this slide, but you can open the DQC RT to see the list of rules that are incorporated in the FASB's taxonomy and which elements are being impacted. So just moving on to the next slide. So I mentioned that the FASB has an acceptance program, and the staff has specific procedures that they follow to incorporate a DQC rule into their taxonomy. They document the purpose of the rule, they get an understanding of the risks that including the rule in the taxonomy would have. They then independently verify any exceptions that they see with the rule. They review the results of running the rules with service providers in the market, as well as with the SEC. And they're monitoring updates to these rules so that their taxonomy is updated. So the 2021 taxonomy will incorporate 6 of the DQC rules, and we've listed them here on the slide. And so what that will mean is that the EDGAR system will be running these 6 rules as filers begin to submit their filings, and they will get warnings if they flag any of these rules. So moving on to the next slide, when you're using the 2021 taxonomy and you you use the Edgar test data set and submit your filing. If you have any errors for these 6 rules that are in the DQC you'll get an SEC warning. And the warning message will give you similar information than you would get from running any of the DQC rules outside of the SEC's site, if you were to run it through your filer agent or if you were running on XBRL's website. But it will give you some information on how to address these errors. So what you see here, this warning message is for a rule that tripped the negative values rule, DQC 15. It tells you which element is being impacted, what the value was, and gives you information about how you should correct this error. You should flip the sign and not be inputting this as a negative. Now, I mentioned that this was happening with the 2021 taxonomy. If you're using the 2020 taxonomy, there's only the 3 rules that were in place for the FASB's 2020 taxonomy, and you're not going to get this detail error message on the 2020 taxonomy. So if you do get warnings and you're using the 2020 taxonomy, I suggest that you have your filing agent run your rules, or you run them yourself on the XBRL US website to get the full information about how to fix these errors. And so moving on to the next slide, I mentioned having your filing agent run your rules. The XBRL US website lists out the software that has been certified. XBRL US certifies software that passes the test to make sure that the DQC rules are running correctly. And so hopefully if your service provider's on this list, then their rules, they're running the rules and their software is certified. If not, you can, as I mentioned, you can go to the XBRL US website yourself, and you can run your file through the XBRL US validator and understand your errors in order to fix them prior to filing. And that is all I have for this section. I believe moving on to the next section, we have a CPE question.
Amy, thanks very much. And Joan, Joan, thanks very much. This is Michelle Savage again. We're going to take a couple poll questions. And then we also have been receiving some questions for the group. So let me just start the poll questions off. These are for those of you getting CPE credit for the session today. So the first question that we have is, which of the following statements best describes the DQC public exposure process for proposed rule sets? Is it number 1, each DQC rule set is publicly exposed for a 30-day review period as it's developed? Number 2, the DQC conducts 3 public exposure periods each year with multiple rules reviewed each exposure period? Or is it number 3, an annual public review period is held at the same time as the FASB US GAAP taxonomy public exposure? So I'm going to give you about another 20 seconds for that poll question. And then we'll be closing this down. And we're going to do one more poll question. And then I think we'll take some of the questions that are coming in. I think Campbell may have been responding to some of them, but okay, I'm going to close the poll down and let you know that the correct answer was the DQC conducts 3 public exposure periods each year with multiple rules reviewed during each exposure period. Okay, so let's go to poll number 2. All right, the Data Quality Working Group, which is comprised of members of the Center for Data Quality, supports the work of the DQC by doing which of the following? By promoting use of the rules, by analyzing how the rules are used, or by developing and vetting the rule sets. Which is the most appropriate response based on Joan's description earlier? So just another 30 seconds here. Okay, just about another 10 seconds. All right, I'm going to close the poll down, and the appropriate response was developing and vetting the rule sets. So they do a lot of things, but that's their primary task, is developing and vetting the rule sets. Okay, so before we move on to rule set 15, why don't we take a few of the questions that have come in? And it looks like various people are answering some of these questions already. So, okay, so one of the questions that has not been responded to yet, are these warnings going to show up in test filings? I don't know if Joan or Amy or Campbell, if you have an answer to that, are the warnings going to show up in test filings? Joan, it looks like you have an answer to that one.
Yeah, I can answer that. Yes, for the 6 rules that have been put into the FASB DQCRT, those warnings will show up in a test filing. So we have a total of 75 rules that have been developed. The remaining ones won't show up in a test filing, but those 6 that Amy Beers was talking about will show up in a test filing.
Great, thank you. The next question we'll take is, and we're getting lots of questions coming in, and this I'm going to pose to Campbell. Are the rules unique for the current taxonomy, or should they have been in place all along, for instance, for prior years?
Yeah, so on this, the FASB has started to incorporate these rules. They incorporated some in the 2020 taxonomy, and then they're incorporating more in the 2021 taxonomy. And obviously the SEC is then picking those rules up and implementing them. The primary concern of the FASB, or the main approach the FASB has taken, is they're putting the rules into the taxonomy that have the, where they're seeing the most errors. So they're the ones they're doing first. So yeah, their goal is to basically catch up and have all the rules in the US GAAP taxonomy. So they're really initially, it's just really a timing issue and a capacity issue, but initially they're putting in all those rules that will have the greatest impact in terms of correcting data quality problems.
Great, and Campbell, the next question, which I think you might want to take, is in the 2020 taxonomy, we saw 3 rules, and now will we see 9 total in the 2021 taxonomy? Is that correct?
Yeah, so you're going to see, as the FASB incorporate the DQC rules into the taxonomy, you're going to see that grow until they cover all of the rules. And so that is correct. That's why you see different rules sets, different rule numbers in these 2 taxonomies. As rules are added by the DQC, the FASB is picking those up.
Great. Okay, another couple of questions. How do we handle calculation assertion errors for parenthetical items on the lead financial statements? They are not really in any of the totals on the page. I don't know, Campbell, maybe you could.
I'm not sure I necessarily understand the question. However, I'll answer it, what I think it means. So there are some calc assertion rules, and they are basically based on, there's a couple, and the one that's been adopted by the SEC is where the calculation reverses from what is in the US GAAP taxonomy. So that's one. So that should never be incorrect. And then we have some other DQC rules, which haven't been incorporated by the SEC yet, but those basically look at where the calculations differ from the US GAAP taxonomy in a way that you would not expect. Now, there are some calculations can be changed from the US GAAP taxonomy. Obviously, we make exceptions for those, and things can be moved around. So those errors, you should generally, those errors will be correct. However, there are also calculation inconsistencies, which are also reported. Those we expect to happen. There are no rules that are trying to stop you from doing that, because we know there are going to be calculation inconsistencies. For example, if the calculation is incomplete because you're reporting information from a prior year, you've got picking up the opening balances, where are those? And also where you've got dimensions, where you may have dimensionalized the data, so it's not going to appear in the calc. So there are valid reasons to have calculation inconsistencies in filings, so that these rules do not address that situation. I'm not sure that answers the question, but I think.
Can I just jump in here?
Yeah.
Okay, I think the question had to do with parenthetical items.
Yeah.
And parenthetical items shouldn't be on the same presentation link as as the main financial statement items. So we exclude the parenthetical link roles from running of these rules. We don't expect any calculation for anything that's a parenthetical disclosure.
Okay, great. Thank you, Joan, and thank you, Campbell. We're going to move on now to the next part of the presentation. And again, if you do have questions, just go ahead and put them into the Q&A, and we can take them as we go through. But I'm going to turn it over to Campbell Pride from XBRLUS, who's going to walk us through Ruleset 15. And this is the rule set that is currently out in public review. So we're looking for input here. So we encourage everybody to go to the public exposure page for this after this session. Campbell?
Okay, thank you, Michelle. So there's a few rules going to go through it. As Michelle mentioned, they're out for public review at the moment. And if you want to run these rules, you can go to our website and you can run them on your filing. You can run them on your historical filings and see which rules come up. And if there's errors. So we've added additional items. We'll just go through what each of these are and the reasons why we're adding these rules. The first one here is just negative values. Every year the taxonomy is published, a new taxonomy is published, and inevitably there are new elements added. So we add negative. We just identify those elements which shouldn't be reported as a negative amount. So they're included here in DQC 15. So if you want to run, if you're moving to the 2021 taxonomy, then these new elements that have been added will be included in that rule set. You go to the next slide, please, Michelle. All right, so on the left, concentration risk. So many companies report this. However, the way that the concentration risks have been reported is quite inconsistent across filings. So what this rule is trying to do in this, there's a whole bunch of sub rules within this, but the idea behind this is to try and get consistency around the way that concentration risk is reported. There is not that much guidance on this. So what this rule is attempting to do is basically provide guardrails so people won't get it incorrect. The FASB has issued an implementation guides in the past, which cover other areas, but do touch on concentration risk and how it should be reported. And pretty much the concentration risk itself it's a little bit complicated, and not everyone really necessarily understands how to do that. So this rule tries to address those issues. And really, the way that these are supposed to be reported is there's supposed to be a numerator and a denominator on those, and those are basically specified by using different axes. And in many cases, we would generally expect there'd probably be 3 axes reporting one of these values, but that's not always the case. And so what these rules do is basically look at these values and identify, where something is made up of a numerator and a denominator, which is like the benchmark and what you're measuring. And sometimes people get those mixed up the wrong way around. And sometimes they only have 1 axis on it. Sometimes the values on it don't make any sense. So this rule is really going to fix those issues. So you should run this on your filings. Maybe you can run on your historical filings and just check it and see if there's a difference. And if you have any concerns or you think you have a situation which is different than the norm, then please let us know. We try to go out of our way to make sure we don't have any false positives on any of these rules. So we really rely on feedback to make sure that we get these rules correct. And that way, the next time you run the rules, those errors won't come up. And we try to be very, very responsive to those questions and concerns. So please don't hesitate to reach out to us. The next rule is the missing a business acquisition axes. Many filers, and it's probably going to be more so in the coming year, is the business acquisitions. And getting the reporting for that right. So what we've done is we've had a look at a lot of the disclosures around business acquisitions, and we've seen a lot of inconsistency in that area. So we've rolled out a bunch of rules to see if we can, provide additional guidance on how the business acquisition information should be reported. It's actually pretty standardized, but there's a lot of there's a few inconsistencies in the way that companies are reporting this, and that's to be expected given that this is not something that may happen every single year or every single period. So it may be new to many people preparing filings. So this rule basically puts in some guardrails. And so this first rule is it looks for one of the things we would expect on a business acquisition. It flags those cases where a company has not used the business acquisition axes. So it basically, this rule will go and look that you've used a business acquisition like line item, but you haven't used the business acquisition axes on it. So if you've got something like business combination consideration transferred and you've reported it for a very short period, we're going to say, well, you know, that's not representing the total of all your business combinations. So you should really be indicating which business acquisition it relates to. And this is an important point, is if you only have one acquisition, you should still be using the business acquisition axes and identifying what the item was, that the actual company or entity that's actually been acquired. Look at the next slide, please. Then we have another rule as well, where there are a bunch of disclosures associated with business acquisitions, and so basically this rule says if you've used one of these line items, you should have the business acquisition axes reported, and then you should have the value that's associated with that particular disclosure. In many cases, you know, they'll say the date that the acquisition occurred, but then not actually indicate what the acquisition, what company was acquired. So it's basically like a grid. If you've got a date that the business was acquired, you need to have a member saying, well, what actually was that? What was the business that was acquired? And there's a bunch of elements here that are listed. And if you're using one of these, the rule will flag and say you've used this element, but you don't have it associated with the business acquisition. We can go to the next slide, please. So there's business acquisitions and then there's asset acquisitions. The two of them are different. And in the 2021 taxonomy, an additional axis was added for asset acquisitions. In the past, people have been using the business acquisition axis to represent asset acquisitions. So the FASB has added this new element. If you're using the 2020 taxonomy and you do have an asset acquisition, you should probably create an extension axis for it, following the, you know, using the same name that's in the 2021 taxonomy, because they are different. And so what this rule does is similar to the prior rule. There's new elements that have been added for asset acquisitions, and you can see there's 4 of them here on the screen. If you do have an asset acquisition and you disclose this information, you should be using it, the asset acquisition axes and not the business acquisition axes. These next 2 rules really just check some of the calculations that are reported in acquisitions. The gross acquisition should be more, the amount that you pay for the acquisition should be greater than the amount net of any cash acquired. So this rule just checks this. And in some cases, people get confused between the elements and use the wrong one. So this is just kind of just a sanity check. Not that many companies get this wrong, but we just put it in there as really like a guardrail. So if you get these elements mixed up, the rule will tell you. And then the next one really relates to the goodwill on acquisition, and there's some elements there for the values acquired and liabilities assumed excluding goodwill. Sometimes if you do the calculation to reconcile between the amount, the assets and liabilities acquired excluding goodwill and the amount including goodwill, you would expect the excluding goodwill amount plus the goodwill should equal the total. So this is just checking that as well. So this is just another a calculation check. And in some cases, folks are using the wrong element for goodwill. So this is really just picking up that. So we go to the next element, next rule, right? There's a general text block rule. There are a couple of text blocks that are used and for reporting the information in the schedule. And one of those is a schedule of acquired finite life intangible assets by major class of text block. And that in some cases, so that element is really the acquired finite, that doesn't relate to acquisitions, and there's a more specific element. And so what this is saying is if you've used that general text block and you've used it on a business acquisition axis, you should probably use the more specific element, which is schedule of finite live intangible assets acquired as part of a business combination text block. So it's just to eliminate people reporting the same fact two different ways. So that's really the new rules that have been added for business acquisitions. There's probably going to be some more at some point in the future because it doesn't really cover all of the issues with business acquisitions. However, we are looking for the FASB to clean up some areas in the taxonomy related to business acquisitions. There's still some things, and some of you have probably noticed this, particularly things around goodwill. The amount that you report for goodwill on the acquisition is the same element that's sitting for the goodwill on the balance sheet. And that can cause some inconsistency problems. So at the moment, we haven't put any rules around that. We've asked the FASB to correct it. So you should still continue to report, use the goodwill element to report goodwill associated with an acquisition. You're just not going to be able to use that element to report the total of goodwill acquired during the period. In addition, we have a couple of rules that are very general. And this first one is a fact value consistency over time. And so what this rule does is it basically looks at values that are reported in the filing. And if you've got values that are reported for sequential periods, but then you also report the total of that period, then it's going to check that the totals match. So this might be on the cash flow, for example. Maybe you reported a cash flow amount and you reported it for the first quarter and second quarter, let's say, and then this rule will basically then check that the sum of those 2 quarters is going to match. Or if you reported an amount for 4 quarters and you report the total for the whole year, it'll add up those values for the four quarters and make sure that total matches the total. And typically what this rule is picking up, for 1 quarter, some companies will use one element, but then for another quarter, they use a different element when they need to use the same one. So it picks up those differences. Sometimes they will report a value of 0 in a quarter when they didn't really mean to do that. They really mean to report, we haven't disclosed that. So then it picks up those kind of errors as well. So it's kind of very general. And in some cases, you may find when you run this rule that actually it does match the values in your filing. And we've seen a number of cases when this rule is run, there's actually been errors in the underlying filing. It's not really an XBRL issue per se. It's just that it's not something you can check particularly easily when you're reviewing your filing. So if you do see this rule, you may want to just pay attention to that and then just make sure that the actual underlying filing is actually correct and you've picked up the amount. Most of those times it's really a value gets reversed or flipped, and that might be in a footnote or something. So it's not part of a total. So it's not easy to check as part of a casting check, but it's kind of quite useful to find those things where you've got inconsistencies if you're adding things over periods of time. Want to go to the next slide, please? Okay, the last one is the same rule, but this is just for the IFRS. So this basically applies to the IFRS taxonomy. So it's exactly the same rule, but we have it as a different number, obviously because it's going to be different. It's different, just have a different rule number when we're applying it to the IFRS taxonomy. So I think that covers all of them, Michelle. The next slide.
Great, Campbell, thank you so much. We're going to go on to some CPE questions now. And I think we've had a lot of questions coming in, but I think that some of our panelists have been responding to those questions, so thank you. Let's go ahead and we'll take the 2 poll questions that we have remaining, and then we may go back and take a look at some of the questions because there may be some that apply to everybody we'll want to address those openly. So again, for those of you getting CPE credit, make sure you take a look at the poll question here. And here's the first one. How many rules have been implemented since the start of the DQC in 2015? Is it 66, 75, or 15? So just about another 30 seconds or so now. Okay, just another 5 seconds, and then we'll be closing down this poll. Okay, so I'm going to end the polling, and the correct answer is 66. 66 different rules have been implemented since the start of the DQC in 2015. So let's go to poll number 4. Which of the following rules in DQC rule set number 15 that Campbell just covered for us cover both US GAAP and IFRS filers? Is it concentration risk, missing business acquisition access, short period, or is it fact value consistency over time? Just take another 30 seconds or so on this. Okay, just like another 5 seconds here before we close down the poll. Okay, I'm going to end the polling. And the correct answer to that one, which of the following rules in DQC number 15 cover both US GAAP and IFRS filers? And the correct answer was fact value consistency over time. That's available covering both taxonomies. Let's take, we have a few minutes remaining, and let's take a couple of the questions that have been submitted. Can a filer submit tagged financial statements that do not comply with the rules? I don't know who would like to take that question. Anyone?
I can take it. So the SEC will not deny a filing if there are errors from the DQC rules. They will accept it. You will just get warnings. There are other issues that the SEC may deny a filing, but the DQC rules is not one of them.
Great, thanks very much, Amy. The next question we have is, for the business acquisition axis, it seems like we generally would not dimensionalize with an axis if there was only a single piece of data for a specific monetary disclosure. I mean, for instance, we're not disaggregating anything. This new rule seems to encourage the use of an axis, even if not disaggregating in this case. I don't know, Campbell, you want to take a look at that one?
And Joan had put an answer there, but I can expand on that a little bit too. Yeah, if you've got one business acquisition and you're just reporting the total that you paid for acquisitions during that period, that might be fine. This rule will only flag if you report a detail that is specific to a filing, like for example, what was the date we purchased the acquisition, right? So if you put an acquisition purchase date, then this rule's going to flag. If you put, for example, what was the total price that we paid for acquisitions, and you put the amount for the entire year, it's not going to flag. If you reported the amount but you put a period on it that only represented a single day, then it is. So because you're providing information about that specific acquisition, and so then it's kind of the data becomes kind of disjointed. The other reason to do that is because, let's say in a subsequent filing, you do another acquisition. Now, what's going to happen, you're going to have the original acquisition still, and it's very common as people do a second acquisition and now they have two. Now, to disaggregate it, you have to put a second element on it, a second member on it. So the data that you filed in your prior filing, now you're actually tagging the data different from the first period to the second period. So what's happening here is you end up putting yourself in a position, if you do have another acquisition, that the data is being tagged differently depending on something which is independent of the first acquisition. So this is kind of a rare case. We wouldn't normally do this, but in acquisitions we notice, because what will happen is it's not like the reporting of the acquisition is confined to a single period of report. You know, the details of an acquisition may be reported over multiple years as different parts of that acquisition are clarified. So that's kind of the reason for it. It's not that we're trying to make it, you know, that this is going to be the start of a trend where, hey, we expect you to put members on every single possible thing, providing details for it. And the question is correct. You know, if you can avoid putting dimensions on things where it's not really providing any more clarification, then, you know, we're not promoting doing that.
Yeah, well, thanks very much. Okay, I think all of the other questions have been answered. If anybody has any further questions, please just drop them in the Q&A. I'm just going to go on and talk a little bit about upcoming events. We have another webinar series coming up starting next week. This is on inline XBRL for small reporting companies and foreign private issuers. And that's going to be on May 19th and 26th at 2 o'clock Eastern. The focus of this is on the fundamentals of inline XBRL for those companies, small reporting companies and foreign private issuers that are in wave 3 of the SEC's rollout. But the material that's going to be covered will be, you know, frankly, very helpful for any kind of filer, regardless of size. On May 19th, we're going to have the SEC's Julie Marlowe, who is going to provide us with some observations on data quality and use. She's also going to talk through some specifics, specific compliance-related issues related to inline XBRL, and also give us some lessons learned from phase 1 and phase 2 rollout. So I think that's going to be interesting for everybody. So we encourage everybody to join that. Then on May 26th, we have our second session, and there we're going to have our guest speaker, the CEO of CalcBench, Pranav Ghai. And he's going to be talking a little bit about how investors use corporate data in XBRL format. And he's going to focus on how small company data is being used today. Pranav's client base is hedge funds as well as mutual funds and other types of investors and researchers. And so he can really speak to what people are actually doing with some of the corporate data in machine readable format, and focus on, you know, why and how they're using XBRL data from small companies. So please join us for that event on May 26th, also at 2 o'clock Eastern. So I want to thank our speakers today. Really appreciate them, you know, going through and giving a detailed overview. We had Joan Berg from Chopin Merrill, who chairs our data quality committee. We had Amy Beers from the AICPA. Amy is an integral part of the data quality committee, and couldn't keep things going without her. And of course, Campbell Pride, our president and CEO. So thanks very much. Please use the rules. Please participate in the public review, and you know, watch your SEC filings, because the SEC is now alerting everybody to you know, certain data quality issues that are identified in those filings. Thank you very much, and we hope to see you next week at our next webinar.